Principles of Microeconomics, Microeconomical Theory and Application. This is your host, Dr. Tulipo Mwenfumbo. And today we are looking at production and costs. So this is lesson 4, where we are looking at production and costs in the principles of microeconomics. So if you want to get more information and the detailed information where you can be able to lead by yourself, you can be able to get this book, which is Principles of Microeconomics, which is written, which I wrote and written by Dr. Tulipo Mwenfumbo. This book is a great introduction to microeconomics principles covering supply and demand, market structure, and public policy, suitable for college students and individuals seeking to understand market fundamentals. So let's dive into today's course. So we are looking at lesson 4, which is product and cost. So we are looking at production theory, cost theory, firms' objectives, and profit maximization. So when you talk about production, we are talking about the term which refers to the process of creating goods or services using inputs such as labor, capital, and raw materials. So production is the process that we use to produce the product or the services. So when we talk about the product and the services, when we talk about services, we are talking about which uses mostly the human capital or the information that are given as a service. Then there is also raw materials. Then we talk about also costs. When we talk about costs in this context, we are referring to the expenses incurred by the firm in producing goods or services. So the expenses that are being used in order to produce the services, those are called costs, and that is what we are going to talk about in this in this lesson. So understanding production and cost is crucial in microeconomics because it helps firms make decisions. So when you understand how production and cost is done, then it is going to make you to be able to make optimal production levels. That is determining the quality of goods or services. So in production, there are two things, whether you look at the quality or you look at the quantity of the product. Then it is going to help also in what is called pricing strategies, that is setting the prices that balance revenue goals and consumer demand. So I was saying that you look at when we are talking about production, we are looking at the quantity and the quality. So there you may find that other clients, other customers may look at the quality and others may look at the quantity. So now when understanding microeconomics in this sphere, it is going to help you to be able to set the price. Then also we talk about the total cost, the sum of fixed and variable costs. The costs, when you're talking about the total cost, we are talking about the sum on the fixed costs. For example, the lentils, you may know that they may be fixed costs. Then there are production costs whereby you value. If you are producing more, then you are going to use less input. If you are more input, if you are producing less, you're going to pay. But even if you produce less or you produce more, when the lentils are still going to be the same. And there are also what is called marginal costs. The marginal costs, there are additional costs of production. So we have talked about determining the quality of goods or services, it will determine the price, and also the cost of the product. Pricing strategies, it will also determine the cost of the product. Then there is total cost, which is the the expenses, the fixed expenses that you use. I gave the example, the building, or maybe the rentals, which may be fixed. So by analyzing this production and costs, firms can optimize their operations and make informed decision to maximize profits. So now let's look at production theory. We are looking at cost theory. Now let's look at production theory. Production theory is a fundamental concept in microeconomics that explains how firms combine inputs as such as labor, capital, and raw material to produce outputs, which are goods and services. So when we talk about production theory, we are talking about the inputs that are used to produce the output. And those inputs are labor, capital, and raw materials, which produces what is called the goods or the services. So the components of production theory. Number one, we have what is called production functions. This is the mathematical representation of the relationship between inputs and outputs. So, you who are doing business administration, we are not going to go into details, but those that are doing economics, you are going to look at the mathematical representation of the relationship between inputs and the output, where you are going to learn about the formulas that are used. Then returns on scale. This is the impact of increasing input on the output. So the impact of increasing input on the output, that is the return scale. So if you put in, maybe let's say put it in finances, if you put in 10 kwacha, then you make the product that is going to sell 15 kwacha. That is called return to scale. So you are going to compare on that one. Then there is also what is called diminishing marginal product. The decrease in marginal output as one input is increased while others remain constants. You may have maybe different products to produce a certain product, or you may have different raw material to produce a certain product. So now there are sometimes a situation whereby there are the marginal diminishing, whereby this material finishes over the other material. So production theory helps firms to optimize production, that is determining the most efficient combination of inputs. So how are we going to make a decision what input, what quality should we be able to produce, and minimize costs? So identify least costly way to produce a given output. I did some consultants with a certain institution, a certain school, where they had this is a college where they had a lot of paperwork when it comes to registration. There was a duplication of paperwork, which was costing and taking a lot of time and a lot of money. So now you look at the production cost, it was just too much. Then I had to advise them, like whereby the budget was somehow about 10,000, 10,000 kwacha. I don't know if it was per month or per 3 months. Now the same things on the one form, it is going to repeat itself, and there will be pages and pages of the forms, which was costly, very costly. So I had to create a form whereby all information can be on one page, and the cost was reduced to about 10%, from 100% to about 10%. So that is what we say: minimize costs, identify the least costly way of production. This we do also in what we call production management. So in production management, that is where we learn how to you can be able to reduce the cost of production. So you maximize profit. So the less that you put in, the more profit that you have. So as the businessman, as the manager, your duty is to ensure that the costs, the input costs, are less. Then you maximize the profits. The key concepts of production theory, there is what is called isoquants. That caves representing different combination of input that produce the same output. So there are inputs that can produce the same output, like what I was saying, whereby you can put all the information on one paper, and this time there is even soft production, whereby instead of using the physical forms, you are using the physical paper. If it was now, if I was to work on that institution now, or to give consultation on that institution on how they can be able to reduce the cost, we may go digital, and that it can reduce even to 1%. From 100% that they were spending, it can even come to less than 10%. Then there is also what is called ISO cost lines. That lines representing different combinations of input that have the same total costs. So by applying production theory, firms can make informed decisions to achieve their production and profit goals. So production theory helps the firm to understand and to know how they are going to use the product. So cost theory, the cost theory is the fundamental concept in microeconomics that explains the various costs associated with production. This involves fixed costs, variable costs, and the total cost. So by understanding cost theory, firms can make informed decision. So maximizing if we are to the other thing is to maximize the profit. How do you maximize the profits? When you talk about maximizing the profit in microeconomics, we are talking about the fundamental of objective of firms in microeconomics. So anyone who is in business, their objectives is to maximize the profit. Their objective as a business person is to make profit. So if there is a chance of making profit, you must be able to make the maximum profits. We are going to look into scarcity and what that is, whereby people will buy product at a very cheaper price, but when they see that that product has got the demand, they raise the price. Why? Because we are in business to maximize the profit. So it involves maximizing revenue, minimizing costs, and optimal output. So we are talking about, if you want to maximize profit, you need to minimize costs and maximize revenue. So meaning that the what you are getting must be more than what you are spending. So components profit maximization. So when we want to make profits to maximize, then we need to maximize revenue. We need to increase the revenue. So also there are theories whereby You produce less products with quality and with a high price, or you produce more products with less price. But at the end of the day, it will depend with the theory that you want. You want. It's just like in spending. It's either if your budget is you get 1,000 and your budget is 1,500. So it's either you reduce your budget to 1,000 or you increase your income to 1,500. So now maximizing revenue, it all depends. It's either there is quantity or quality. So either quality or quantity can be able to help in the maximizing of profits. Then minimizing of costs, reducing expenses to increase profitability. So that is whereby now you have to you use like I've seen the bakers whereby they'll be able to remove some ingredients into products, maybe into cake. So they'll be able to give you different prices of cake. What is determining the price? It is the input. So now the in that can also be able, you reduce the input so that you maximize the profit. Optimal output, well, that is determining quantity that maximizes profit. When we talk about optimal output, that is where now you reduce the the you reduce the quantity. This usually happens when they are increasing the price of maybe the bread or buns. You may find that they'll begin to make them big. But when in actual fact you may find that the price has gone up, then they'll begin they are going to use optimal output. So they are going to start reducing the size of that product to maximize profit. So firms achieve profit maximization by setting optimal prices, that is balancing revenue goals with the consumer, producing efficiently, that is minimizing cost and maximizing output, and responding to market changes, that is adopting to changes in demand, cost and competition. So the demand also has much effect on maximizing the profit. So profit maximization is a key drive for business decision, guiding firms to allocate resources effectively and make strategic choices. So by applying production and cost theory and also maximizing the profit, the business can make informed decision and improve efficiency, reduce costs, and increase profitability. So business decision making, the maximization of profit maximization, product theory, production theory, and cost theory, they all helps to make decision as business people, and also they make the firm to be able to strategize on pricing and also on price resource allocation, where are they going to allocate the resources, which is production and cost theory guide firms to allocate resources, and also industrial analysis, that is analyzing production and cost structures helps understand industry dynamics. So that is for more things, if you want to learn more about what we have just briefly talked about, and you want your business to thrive, and you want to be a great CEO, and as someone who has done business administration, it is very important that you get this book, Principles of Microeconomics, written by Dr. Tulipo Mwenfumo. And to order this book, you can WhatsApp on +260 976 18 12 53, +260 976 18 12 53. Thank you so much, and God bless you. Remember to come in the next class. Let's meet in the next class. Thank you so much.